The stock market has no political affiliations or national allegiances. Most stock market investors are only interested in one thing. That is, of course, making money. This is why the performance of the stock market of a country is a fairly objective assessment of the present and future state of that country. The fact that the US stock market has been the best performing in the world over the past 10 years says much about a dynamic and entrepreneurial economy that is the bedrock of the American hegemony. The US stock market has done so well over the past decade that it outperformed the Chinese stock market, the second largest stock market in the world, in 8 out of the past 10 years. The implication is that with all the talks about a US-China rivalry, China still has her work cut out for her if she wants to catch up with the US. But 2023 was supposed to be different. At the start of the year, the consensus on Wall Street was of a 65% chance the US will go into a recession this year. Meanwhile, the expectation was that the Chinese economy was going to take off following China's 20th Party Congress and the termination of Beijing's zero-tolerance policy. For this reason, from November to January, the Chinese stock market outperformed the US stock market by a whopping 40%. Will the Chinese outperformance over the US continue? Is the buy China, sell US investment thesis grounded in reality? If inflation is the biggest risk facing the US stock market, what is the biggest risk facing the Chinese economy and the Chinese stock market? What does the Chinese recovery really mean for the global economy and financial markets? Hi, I'm David Wu, a former Wall Street strategist with a 20-year track record of making actionable predictions about major global change. Welcome to The Money Game, where I take on groupthink, propaganda, and conspiracy theories in my critical analysis of markets, economics, and politics. Before we begin, please hit subscribe and the bell button so that you'll be notified when a new video comes out. In last week's video, I gave you my thoughts about the state of the US economy. As a reminder, my bottom line was that with the US economy regaining momentum at the start of 2023, I'm ever more convinced that the Federal Reserve will keep raising interest rates until financial conditions tightening enough to put the inflation genie back in the bottle. This may or may not lead to a recession, but it almost certainly means a much lower US stock market. The situation in China, however, is quite different, and so is the risk. For one thing, inflation is not a problem in China. Chinese consumer price inflation came in at a modest 2.1% in January. Stripping out energy and food, core inflation was even lower at just 1.1%. This means the People's Bank of China, China's central bank, has room to cut interest rates. And it follows that monetary policy is likely to remain accommodative in the foreseeable future. But low interest rates are not enough to keep investors excited about the Chinese stock market. Much of the outperformance of Chinese stocks since last November was based on the expectation that the Chinese economy will accelerate strongly this year. Recall, last year the Chinese economy grew barely 3%, the second worst performance since 1976, with Chinese industrial profits falling 3.6% in the first 11 months of the year. Indeed, the Wall Street consensus is that China will grow 5.2% in 2023, led by strong acceleration of retail sales to 7%, up from 1% last year. Is this a realistic expectation? It's too early to say, especially given it hasn't been even a month since the end of the celebration of the Chinese New Year. But the underperformance of the Chinese stock market in Asian markets over the past 3 weeks in general suggests the market is getting cold feet. The good news is that people are back on the move in China after the lockdowns were lifted. Cities across China have reported a pickup in subway passengers, for example. Air China, China's flag carrier, reported a 54% increase in air passengers in January, including a 373% increase in international travelers compared to a year ago. The increase in mobility has not so far translated into stronger car sales. In January, auto sales plunged by 35% from a year earlier to just 1.65 million units, the lowest figure for the month since 2012. Anecdotal reports suggest that the shopping streets of big cities like Shanghai have yet to return to their pre-lockdown hum. And yet, a recovery of the Chinese economy hinges on Chinese consumers going on a spending spree. The bullish China thesis is predicated on the assumption that the Chinese consumers will be drawing on their excess savings from the lockdown period that has been estimated to be just shy of $1 trillion US. The saving rate in the US fell sharply in 2022 as life returned to normal. The market is betting that this pattern will repeat itself also in China. This is why French luxury producers like Hermès and LVMH are trading at their all-time highs. The two most important determinants of the saving rate are job security and wealth. When we feel secure in our job, we save less. When our wealth goes up, let's just say because of a rise in the value of our investment portfolio, we save less. In the case of the US, the sharp drop in the household saving rate we saw in 2022 can be explained by a remarkable tightening of the job market that's resulted in 2 vacancies for every job seeker and the 50% increase in the US stock market during the 2 previous years. What about China in 2023? The unemployment rate at 5.5% is off the high of the past 3 years, but it is still high compared to pre-2020 levels. Meanwhile, youth unemployment rate was at 17.3% in January. A survey of about 50,000 white-collar workers published last week by one of China's biggest recruiting firms showed that 47% of respondents are worried that they may lose their jobs this year. My daily survey in partnership with Reassess shows that the perceived availability of jobs in China, which had improved after the lockdowns were lifted, had dimmed over the past 2 weeks. The current state of the labor market, therefore, does not bode well for the Chinese household saving rate to come down. What about wealth of Chinese households? Well, more than 70% of the net worth of Chinese households is house ownership, whether as a home or as an investment. In short, property equals wealth in China. But the bad news is that China's new home prices fell for the 16th consecutive month in December, with the number of Chinese cities that saw a fall in home prices rising to 55 in December from 51 in November. The slowdown of the Chinese housing market began in 2020 when the government rolled out its policy of the 3 pillars that was designed to rein in highly indebted property developers. In 2021, the liquidity problems of China Evergreen, once the most valuable real estate company in the world, burst out into the open. In 2022, the housing crisis entered into a new phase when angry home buyers refused to pay mortgages on unfinished homes that the developers did not have the funds to complete. Beijing has since made local governments responsible for ensuring the delivery of housing projects and created special loans to help developers finish stalled housing projects. This has definitely alleviated the situation, as evidenced by the fact that at the end of last year, the floor space of buildings under construction has fallen to just 50 million square meters, down from more than 200 million square meters at the peak in 2021. However, confidence in the property market has taken quite a hit. Home sales were down 25% in December, and floor space of newly started residential buildings was down 44%. Meanwhile, inventory of unsold homes remains near an all-time high. In the case of some big cities like Shenzhen, the inventory is 400% higher than only 2 years ago. The Chinese housing crisis is manageable, but it will take time, especially given that the Chinese real estate market is the most overvalued in the world. Now, what about exports that for so long have served as a key driver of Chinese growth? Well, export growth is slowing. Export growth fell from 20% at the start of last year to just minus 0.5% at the end of last year. With the global economy set to slow and the reshoring by US and European companies that I talked about in the previous video, exports are likely to contract in 2023. So what does all this analysis leave us? I don't like the US stock market because it is expensive and because I think the market is still underestimating the stickiness of inflation and the resolve of the Fed to bring inflation back down to 2%. The Chinese stock market is not expensive, but I think upside growth surprises are limited given the headwinds facing the economy. The Chinese government is very likely to announce new fiscal stimulus next month, but is unlikely to address the decline of long-term growth rate. As the International Monetary Fund pointed out in its 2022 Article 4 consultation report, China is falling behind in pro-growth reforms, such as ensuring competitive neutrality between private and state-owned firms, a necessary step in shoring up productivity growth at a time of shrinking labor supply. And finally, there are also geopolitical risks to consider. It feels like the Biden administration is trying hard to provoke Beijing into doing something that will give the US the excuse to hit it with even more sanctions. Last week, Anthony Blinken accused China of considering sending lethal weapons to Russia and warned of serious consequences. Whether the accusation has any merit or not, the implication is that an intensification of the Russia-Ukraine war in 2023, which in my view is inevitable, will provide Washington with even more reasons to weaken China economically. The reality is that in the economic war between the US and China, China has relatively limited leverage, at least right now. After the US froze Russia's foreign reserves, it is not even clear that China's holdings of more than $850 billion of US Treasuries gives it much bargaining power anymore. The US knows this only too well. I suspect this is why Washington is pushing China harder and harder. In my view, this remains the biggest downside risk to the Chinese stock market in 2023. If you got something out of this program, please hit like and subscribe to my free YouTube channel. If you want to learn more about my investment strategy, come visit us at davidwuunbound.com. Thank you for listening.